This is the overview for Chapter 3. Chapter 3 is now talking about cost-volume-profit relationship. So we're going to explain how changes in activity affect the contribution margin and net operating income. So, basic overview of cost-volume-profit analysis. The contribution income statement is helpful to managers to judge the impact on profits of changes in selling price, cost, or volume. The emphasis is on cost behavior. So below we have a racing bicycle company contribution income statement. So the very first thing is sales. We sold 500 bikes. That's 250,000. Less variable expenses, 150,000. So we have a contribution margin, or also referred to as CM, of 100,000. We subtract out fixed expenses, which were 80, and we have a net operating income of 20,000. The contribution margin, or CM, is the amount remaining from sales revenue after variable expenses have been deducted. So we have $100,000 remaining after variable expenses. The CM is first used to cover fixed expenses. Any remaining CM contributes to the net operating income. As you can see, we first cover fixed expenses, and then the remaining is net operating income. The contribution approach. So sales, variable expenses, and contribution margin can also be expressed on a per unit basis. If they sell an additional bike, $200 of CM will be generated to cover fixed expenses and profit. The way we get this is we take the 250,000 and divide by 500 bicycles. That means each bike sells for $500 per unit. Then we take the $150,000 in variable expenses and we divide by 500 bicycles. That means variable expenses are $300 per unit. So therefore, each bike contributes $200 per unit. This is very important because you may want to know, well, what if I sell one more bike? What if I meet one more customer? What if I do this? Then you want to know how much each item contributes to your bottom line or to cover fixed expenses. So each month, the racing bicycle company must generate at least $80,000 in total contribution margin to break even, which is the level of sales at which profit is zero. Well, this is very important because although we want to make profit, we definitely have to break even. And so this is called a break-even analysis. So we would take this $80,000 and divide by $200 per unit, or our CM per unit, and this will calculate how many bicycles we must sell to break even. Well, here it is. If they sell 400 units per month, 80,000 divided by 200, they will break even. So they'll have $200,000 in sales, they'll have 120 in variable expenses, and they'll have 80,000 in contribution margin. They'll subtract the fixed expenses, and we're at zero or break even. What if they sell 401 bikes? Well, they should make a profit of $200. You can figure out target profit or break even using this same formula. We're going to do some practice after this. So we don't need to prepare an income statement to estimate profits at a particular sales volume. Simply multiply the number of units sold above break even by the contribution margin and we will get that. So if they sell 430 units and each unit contributes $200, break even was 400, so 30 units times 200 is $6,000 worth of profit. The contribution format income statement can be expressed in the following equation. Profit equals sales minus variable expenses minus fixed expenses. This is exactly what we're doing here down below. This equation can be used to show the profit they will earn by selling 401. Notice the answer 200 mirrors the earlier solution. So 401 units, so sales equals number of units times selling price, variable expenses equals number of units times variable expense, and then fixed expenses are fixed. So 200,500 minus 120,300 minus 80,000 equals $200 in profit. When a company only has one product, we can further define the equation as below. Quantity sold times selling price equals sales. Quantity sold times variable expense per unit equals variable expense. So therefore, profit equals P times Q minus V times Q minus fixed expense. Basically, we're showing you multiple ways to solve the same problem because sometimes you don't have all the information. But just notice, we're solving the same problem. What is profit here? And we're just setting it up different ways. This equation can also be used to show how $200 worth of profit earns if 401 bikes are sold. Again, we're rewording the same exact problem. So it could be expressed as profit equals selling price times quantity minus variable expense times quantity minus fixed expense, or selling price minus variable expense times the quantity minus fixed expense, or the unit contribution margin times the quantity minus fixed expense. This will all get us to the same equation. So let's see. Let's use the same last example. So our selling price minus our variable expenses that would equal $200 times 401 minus 80,000 equals 200. So now we're going to go do some practice from the chapter. I will post that in a separate